Good morning and welcome to this Wednesday, July 29th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Saw kind of a late day sell-off yesterday. Not overly surprised. We did have leadership during the day from our defensive areas. Utilities, real estate, consumer staples were all leading the action to the upside, and I never feel very good about that. I'd rather have our aggressive areas leading. And we did see some selling at the end of the day. Last hour, we saw the Dow go from positive territory down a couple hundred points at the close. So not a good finish, but I think we're consolidating. I mean, we're in the middle of earnings season. We had a good run up into earnings season, and now I think the market is digesting the news. So we're going to get into that. A ton of earnings out, by the way, between last night and this morning, and that's only going to pick up here over the next couple of days. So we got a lot of earnings reports to get over, and I'll go through that in a minute. But today I just plan on going through, checking out the daily market recap, looking at what happened yesterday. Got a couple of economic reports. Well, one economic report, then of course the FOMC, got the Fed meeting. They'll have an announcement later this afternoon. We'll get into talking technically. I'm going to show you a couple of price relative charts that I use that just give me a little sense of what's taking place in the market. You know, should I be bullish? Should I not be bullish? You know, some of the things that I look for to really solidify and advance to the upside, but we'll talk about that during talking technically. Going to try to run through a chart list or two, run some scans against chart lists. We'll get into earnings spotlight, upgrades, downgrades, and then we'll wrap up with three you must see. Before we get into any of that, I do want to just point you to our earningsbeats.com page, and let me go ahead and pull that up for you. If you go over to earningsbeats.com, if you are new to us, I would suggest signing up for the Earnings Beats Digest newsletter. It's free, no credit card required. We're going to send you articles Monday, Wednesday, Friday morning. They're usually just short little snippets with a chart showing maybe featuring a company maybe that's coming up for earnings and what it looks like and what we might expect. Could be just a stock that's performing well on a relative basis. We could be highlighting a sector or an industry group. We do try to make these all educational in nature, but also some good trading ideas come out of that as well. So if you haven't already subscribed, would strongly suggest that. I also want to mention, come join us. We do have a $7 30-day trial, which is fully refundable. So the $7 will be sent back to you as a credit. So you get 30 days for free. And if you sign up now, the 30 days covers basically through the end of August. And our biggest webinar coming up in the next quarter is August 19th, when we unveil all of the stocks in each of our portfolios. And you can see based on the performance here, we've got pretty strong results, not just this quarter, but really since inception. And so I think this would be a great time to join. Just check out our service over the next 30 days and see if it's for you. All right, let's move on into the market, see what happened yesterday. As I mentioned, we did finish a little weak in the final hour. Dow Jones Industrial Average down 205 points. The S&P 500 down 21. NASDAQ down a little bit more than 1.25%, down 134 points. So on a relative basis, this was your weak group. So the NASDAQ, and again, as I mentioned, the defensive groups were leading. We don't have a whole lot of representation of defensive sectors in the NASDAQ. It's mostly, more of the aggressive groups. Mid caps, small caps, both down, but did better than the NASDAQ. As far as our sectors go, this is what I was talking about. Real estate up more than 2% yesterday. Utilities up 1.5%. Staples up about 1/3 of 1%. All three of those groups are defensive. So that's where we were primarily seeing strength on Tuesday. And it just doesn't make me feel very good from a relative basis, or just, evaluating the market when we're seeing defensive groups lead. It was just one day. I wouldn't take a whole lot out of that, but it doesn't make me feel like we're going to have a huge day when we've got defensive groups leading. The market's just being a little bit more cautious. All right, healthcare you can see was relatively flat yesterday. That was the fourth best group. That's got some defensive characteristics and some offensive characteristics, but healthcare also near the top of the leaderboard, even though it did fall a little bit. Bottom of the leaderboard was a group that's been leading the market, and that was materials. Materials had a rough day, down more than 2% yesterday. And it's kind of hard to pinpoint exactly what was going on, except we did see a slight uptick in the dollar, and the dollar's been down almost every day in July. It's been a really rough couple of months, to be honest, since probably mid-May. The dollar has been falling, and you can see since mid-May, we've had a really nice run in materials. So if the dollar continues to fall, and we're kind of teetering here, this is a pretty important level on the dollar. And if we do break down, I expect the materials could be the leading group going forward, maybe for the balance of 2020. But if we get a reversal in the dollar this week and we leave a long tail to the downside on a candlestick chart, a weekly candlestick chart, that could put in a major bottom on the dollar. So which way we go, and a lot of times the dollar is impacted pretty heavily by what the Fed has to say. Interest rates here in the US versus interest rates globally has a big impact on how the dollar performs versus other currencies around the world. So anytime you have a Fed day, you want to pay attention to what happens to the dollar, and even more so, I think, this month, because we are on that long-term trend line on the dollar. And I'll pull that up and just show it to you quickly here. I'm going to pull this up on a weekly basis. Let's go back 20 years. And just pull it up on a line chart. All right, so if I annotate this, what I'm referring to, I mean, when you start talking about a trend line that goes back 9 years, that's something to pay attention to. And there is the trend line. Now, right now we're breaking it, but keep in mind, this is a weekly chart and it's a line chart, which means it's only showing Friday closes. So I could probably drag that up just a little. But I mean, that's hitting these lines perfectly. Now, right now, if we closed Friday where we are, then we would be breaking this trend line, which I think is something to absolutely pay attention to. But what happens if we reverse off this Fed meeting and by Friday we're back to 95 on the dollar? Then what we could be seeing simply is a test of this long-term 9-year trend line with the dollar rising again. And if the dollar rises, materials will not be leading this market to the upside. It just doesn't happen that way. I guess I shouldn't say it won't or it can't, but generally speaking, when the dollar is strong, materials and energy are going to lag on a relative basis. All right, so that's something we definitely want to be watching coming out of the Fed meeting today. I know a lot of folks will be looking at the stock market, seeing how the stock market reacts. I'm going to be watching the dollar probably as close as anything, because I think this is going to have a major impact on the next several months in the market. All right, the 10-year Treasury yield. As far as economic reports go, we did have, or we will have in less than an hour, June pending home sales coming out. And if you recall, last month, the May pending home sales came out. It was up 44.3%. But we were coming out of lockdown in most areas around the country. So that was kind of a skewed number. But June pending home sales still expected to rise 5.2% as more and more economies have opened throughout the country. People are out and about a little bit more. 5.2% looking for a pretty good rise in pending home sales. So we'll see how that pans out. Let me get an update here. That was from probably 40 minutes ago. Yeah, we're still down 0.577%. And this is a pretty important low that we're at. But we'll see what happens when the Fed meets and they come out. It could be a lot of folks jumping into treasuries. And after the Fed reports, we could see a sell on the news in terms of treasuries, which would send the yield higher. I wouldn't be surprised because we've been going down into the meeting. Once the meeting's behind us, I wouldn't be surprised if we do see a pop. And if that happens and we do see that pop, that's when the dollar could reverse, materials could get hit, could see profit taking in that area. And then we could see money rotate maybe into the financials and industrials a little bit more. All right, let's keep moving. So when I look at the market long term, there are a couple of ratios that I really like to follow. One is the XLY versus XLP. and that's the consumer discretionary versus consumer staples. So it's really looking at the group, or two groups. One group is more of a, it's buying the things we want. That's really what consumer discretionary stocks represent. It's not things that we absolutely have to have. It's things that we want. So when the economy's good, or we think the economy's good, we're feeling good about things, normally we're going to buy more discretionary items on a relative basis to consumer staples items. When you think staples, you should be thinking like toothpaste, deodorant, stuff like that. I mean, you're going to buy that. You're not going to say, well, the economy's bad, I'm not going to use deodorant this week. I mean, come on, let's be serious. So consumer staples are things that are going to be bought anytime, regardless of economic conditions. So their business doesn't really fluctuate as much based on the economy. Consumer discretionary, on the other hand, is very tied to the economy. You got areas like restaurants in there. Of course, restaurants are a bad example because of coronavirus. But normally, in a normal environment, if you're feeling good, you're going to go out and you're going to eat out more. If you're not, you're probably going to stay in, go to the store, grocery store, you're going to buy more of those consumer staples, and you're going to go home and fix dinner. So it's just those types of things, buying that new car versus fixing up the old one. If you feel really good, you might go out and get that new car. That's consumer discretionary. If not, you want to just, fix it up, then obviously some of those auto companies aren't going to do as well. Same goes with buying a home and home improvements. They're all consumer discretionary. So really important to follow this ratio. And what I want to show you on this chart, if you're not familiar with it, when the XLY XLP ratio is going up, normally that coincides with the stock market going up, the S&P 500. If you don't believe me, look at the correlation. This is a correlation coefficient that tracks the direction of the XLY versus XLP and the direction of the S&P 500. So the ratio versus the S&P 500, and it is almost always in positive territory, almost always above zero. And if I put in like a shaded area here above 0.5, you would see that most of the time it's spent above 0.5. Very strong positive correlation. So as goes the ratio here with consumer stocks, as goes the S&P 500, typically. Now, I'm going to argue that we're in this sideways consolidation, because normally what happens is you go up, you consolidate, you go up, you consolidate, you go up, you consolidate. That's really what you see during bull markets, secular bull markets, normally is what you see. Well, if you follow this, here we move up, the S&P has a nice advance. Here we consolidate, the S&P struggles. Here we go up, S&P advances. Here we consolidate, S&P struggles. Here we go up, S&P rises. Here we consolidate, and you can see the back and forth that's taking place on the S&P. So I think just looking at this chart, obviously a breakout to a new high here would be very important. Now, there are some opponents to this that would say, well, the XLY is 23% or 25% Amazon. That's not a good reflection of consumer discretionary. Should we use equal weighted? Well, I got a question for you. I mean, if you go out and you find some $100 million consumer discretionary company, do you think it should have the same weight in determining how our economy is operating as Amazon? I mean, really? I think that Amazon has a much bigger influence. I mean, I want their market cap to be represented more in this ratio. I don't want a small little consumer discretionary that's been going sideways for 20 years, little up, little down, little up, little down, going nowhere. I don't want them to carry the same weight in this relationship as Amazon. So I would argue the other side. Yeah, I want Amazon. Amazon's a big part of our economy. Why would we want to treat it the same as some small company that has very little impact? So I don't understand the whole argument using equal weighted, and I see it all the time. I think it's more important just to follow Amazon, follow their technicals. If they break down, then yeah, that's going to be a warning sign, because Amazon has become a big part of consumer discretionary. But anyway, follow this sideways consolidation. We can expect more of the same. We get a breakout here, and I'm just saying, we got a breakout back in fourth quarter 2017. We had a pretty nice run. Then we got, of course, into the trade war and so forth. We broke out in 2013. above prior highs. Look at the rally that we had. 2013 into 2014 was very strong. And obviously we didn't have perfect hindsight, but if we go all the way to the bottom and look at this move up, this whole trend, that coincided with basically the whole trend from 2011 to early 2014. And then we went into this sideways consolidation, and you can see the market struggles. So watch for a breakout here. It could very well be that this low coincided with this low, and if we break out, I would expect the S&P to go right along with it. Now, the other chart that I look at, and this one is not as bullish right now, transports versus utilities. Now, if you go back and you look at this, again, look at the correlation, transports versus utilities, comparing it to the S&P 500, and you can see we are mostly in positive territory, not 100%. I don't know anything that's 100%, but this is a pretty good indicator. When transports are outperforming utilities, we should expect the market to go up. Well, since the bottom here, and I don't know if this is the real bottom, but since the bottom back in March, we've been moving higher in this ratio. The S&P's been moving higher, and you can see the correlation, very positive. Right now it's at 0.78. Now we've been hitting this downtrend line. I think it would be very bullish to break out here. If you look back 2012, 2013, 2014 in this move, what happened? Transports broke above this trend line, this transports versus utilities trend line, which was downtrending. That broke. When that broke to the upside, that was more reason for the market, in my opinion, to go higher. In 2016, 2017, you could almost make the same argument here, although we broke out in 2016, pulled back a little bit, but then had another staggering move here to the upside that coincided with the top right there in the S&P 500. So when people ask me, how can the market go any higher? What could possibly drive the market higher? Well, I can tell you, if consumer discretionary breaks out and this downtrend breaks, I mean, transports haven't really been performing well. Why can't transports take off if the economy strengthens? So I think this is, you know, we might not seem to see the same leadership, but in a roaring bull market, you get rotation. It's certain groups lead for a while, they take a break. While they're taking a break, the money moves over to some other area, which takes, you know, kind of like a 400-meter 4x4 relay or something, you know, where you're just passing the baton on to a different group, and then that group takes off. So watch transports. I mean, if we break this downtrend line, transports, railroads, they could be huge leaders coming up the second half of this year and into 2021. All right, chart lists. Let's keep moving here. And what I want to just talk about here with the chart lists is I like to run scans against our chart list. And if you're an Earnings Beats member, you know we have 6 different chart lists. We have 5 different scans that we like to run against them. So I'm just going to pull up today one, it's the RSI 40/50 scan. And I'm going to edit the scan. Essentially, it's a very simple scan. The RSI greater than 40 and the RSI is less than 50. So you're looking for RSIs between 40 and 50. Now, why would I want to run this? Well, in the strong earnings chart list, we have companies that I believe are strong technically. They're already liquid. Notice this scan right here doesn't say anything about volume. I don't need to make sure volume's a certain level because they wouldn't be on our strong earnings chart list if they didn't already have the amount of volume that we want to see in our stocks that we trade. So all it is just pulling up this RSI 40 to 50 scan and looking for solid companies that have pulled back. You can't get an RSI between 40 and 50 by going up and up and up every day. So this scan is not going to return the companies that have just kept going higher and higher and higher. This scan is going to pull up hopefully companies that have been pretty strong, but have simply pulled back for a period of time. And if you've followed trends and you look at charts and you try to see some of the common characteristics of uptrending stocks, uptrending indexes, many of them, when they pull back with an RSI in the 40 to 50 area, many times that's where you see bottoms hit. So that's the whole idea behind this scan, is to look for potential bottoms in a strong group of stocks. So I'm going to go down here now and I'm going to add in the strong earnings chart list that we have. And all of these chart lists, if you're a member at Earnings Beats, you can download right into your account. Very, very simple to do. We give you a link and a password. You literally click on the link. You have to make sure your stock charts account is open, but you click on the link and a box will come up asking for the password. You type the password that we provide for that chart list, not your stock charts password, not your earnings beats password, but the password that we specifically identify for each one of those lists. And then it pulls the list up and that gives you basically an option to download it right into your account. Save it as a new list or overwrite a previous list. So if you've already downloaded the strong earnings chart list, all you do is you come over in and you just re-download it. Overwrite the strong earnings chart list you already have in your account. Anyway, it's very, very simple. So here's my RSI 40 to 50 scan, and I'm going to run it against the strong earnings chart list. I'll check syntax, make sure that Stock Charts agrees with me here. Yep, scan syntax is correct. Now I can run the scan. And so now I'm going to run a scan and just see which stocks in the strong earnings chart list are between 40 and 50. I've got 45 stocks. You know, I get questions sometimes, how can you get in the market? The market's gone up so much. Well, if you're looking to get into the QQQ, I understand. You know, the QQQ's been on fire for a long time. But if you're looking to get into individual stocks, I mean, I can sort this by sector. There's 5 consumer discretionary stocks on this list. There are 8 healthcare stocks. There are, I don't know how many technology stocks, looks like maybe 20. And the other thing you can do is sort it by scooter and then by sector. Hold on, let me try this again. Scooter and then by sector. Okay. So here are your highest scooter scores among consumer discretionary. Winnebago, we'll pull that chart up in just a minute. Healthcare, TBIO, Translate Bio. It's a small cap. Some of these are small cap. And that's another thing you got to be careful. If you're a little bit more risk averse, then you want to maybe stick with large cap stocks that you're more familiar with. Small caps are going to be more volatile. And one of the reasons small caps are more volatile, they normally don't have as many market makers making a market in that stock. So when you have, you know, just a handful of market makers that are controlling most of the movement in a stock up and down, and they're trading for their own account, they whipsaw you. You know, and that's why some of these small caps, you know, people get in and they just hold like they do Apple, and it just doesn't work out the same. And small caps aren't Apple. Anyhow, healthcare, TBIO, you can come down to technology. Trade Desk hitting the list. How often do you see Trade Desk with a RSI between 40 and 50? Let me pull this one up first. It's just been sideways consolidating here for a while. I don't see anything bad with this chart. Let's get rid of that accumulation distribution and let's go pull up the RSI. And there you have it, RSI 49.74. I mean, this is the first time the RSI has gone below 50 on this stock in a while. The pullback's been on light volume. You know, and then if we pull up relative strength, Trade Desk, which had been a leader, let's see here. Yeah, I mean, it's been a great stock versus software. It's consolidated a little bit. Same thing against the S&P. Software has been consolidating against the S&P. So, you know, the stock was over 475. Now it's at 419. I guess, you know, would you rather buy it when you know, you have all this excitement out there, it's overbought and 475, or would you rather buy it when it's 419 after it's pulled back for a few weeks? I mean, that's what this scan does for you. It will quickly identify stocks that might make more sense for you. All right, let's go back. I want to pull up that other chart. All right, so which one was it? All right, so Winnebago was the other one. So let's see what's going on with Winnebago. If we get the chart up, there we go. Same thing, went up. Look at this, negative divergence. Normally we look for 50-day tests, get that PPO back to the center line. That's where we are. And again, if I go down, pull up this with using the RSI. RSI, well, you can see right here, got down right to 40 back in the second week of July, right at the bottom. 10% move over the next week or two. Well, it hasn't really done much. It's just gone mostly sideways, pulled back a little bit, still sitting at the 50-day. And now you've got the RSI still with it right now at 49. But again, there's your 40. That was perfect. So you could even narrow this search down to say 40 to 45, not 50, but wait, try and get it even closer to 40. But anyway, I can go on and on about that. But definitely, these scans and all these scans, we have the scan syntax over at our website under scanning strategies. So you can grab this scan. There's some others, 52-week high, a downtrend reversal scan. We write the syntax, which usually is pretty simple. All you do is copy it, come to stock charts and paste it, and then run it against one of the chart lists that we provide you. Very, very easy way to find some great trading candidates. All right, next up, let's get into earnings because we do have a bunch of them. Starting to run out of time already. I'm just going to go over a few of these. I will tell you, AMD, they came in 18 cents versus 16 cents. Completely different reaction to what we saw with Intel. AMD is currently up 11%, up over $75 now. So this was a stock we were watching for this breakout. We got it. Stock pulled back. AMD went up on Intel's woes. Intel's earnings report actually sent AMD higher. Pulled back a couple of days, but now AMD comes out with its earnings, beats expectations, and the stock, another big move to the upside. And, AMD hasn't really done what some of these other stocks have done that have gone straight up, Shopify, Tesla, and so forth. This stock may just be starting a very, very big move to the upside. Again, low interest rate environment, if you're a leader and you're showing you can grow your earnings more rapidly than the market expects, you get rewarded. AMD, I think, is going to be a really good stock for a while. I mentioned Shopify. Shopify reported. Big reaction to Shopify. Stock's up $121, up 12%, breaking out again. Shopify came out with expectation was for 1 penny, earnings of 1 penny. They came out with $1.05. $1.05. That will change some valuations. So if you're wondering why Shopify was 300 back in April and now it's 1100, well, the market prices these things in. Wall Street meets with management teams. They know what's going on in these companies. They go back, they revise their earnings estimates higher. They do revaluations of what they think the company's worth. And then when they see the numbers, they buy. They buy for themselves, they buy for their clients. And that's what drives prices higher. That's why it's so important to follow the technicals, because the fundamentals come out later. Technicals drive the move. Now, technicals aren't always correct because management isn't always truthful. I mean, we do have a human element here. Sometimes management teams are just overzealous. They're really excited. They paint this picture of everything's rosy and it's going to be perfect. And then their actual numbers come out and they're not that great. And so, Wall Street bids their shares up in anticipation, and all of a sudden the numbers don't come in quite as good as they thought, and the stocks pull back. Anyway, Shopify, big number, nice reaction here. Let's see, what else do we have? How about SMG, which is Scott's? I think Scott's Miracle Grow, but Scott's big move up here. See this little cup, little handle? What's in the rear view mirror this morning? Scott's up more than 11% this morning, 162. So we're getting a breakout. Now, does that mean you jump in at 162? No, not for me. I need to see how a stock trades after it gaps up. Most stocks fill their gaps. So when a stock goes up to 162, most stocks would come back down to 145. But some stocks will gap up to 162, and before you know it, it's 172. That is very bullish, because when a stock gaps up, everybody's jumping in. Market makers are on the short side. If they can't get control of the action, that tells you the demand is so great that a stock keeps going up, even in the face of short sellers in terms of market makers. And that normally means the top of gap support becomes very, very strong. And I wouldn't wait for a gap fill. So, but you don't know when a stock opens up, you don't know what the demand's going to be. You don't know if it's going to keep going higher in the face of market makers shorting. You don't know if it's going to pull all the way back. It's something I use. I evaluate it, and that's why it goes on our strong earnings chart list. If a company comes out and beats and they have a nice reaction, it goes on our strong earnings chart list, and then we can evaluate it. over time. We don't have to buy today. Another one that came out, pretty good numbers, FireEye. This was yesterday after the close. It's not showing, oh, market just opened, that's why. So we can get a real time. Oops. So FireEye coming out. They came in with 9-cent earnings. The market was expecting a 2-cent loss. Look at that rally up over this high. Now, again, I would expect that it's going to pull back, but I don't know that for sure. I wouldn't short it. I just don't short in a secular bull market. It just doesn't happen. This stock, if I shorted it at $14.95 and it got to 15.25, I would just get out. I don't want to lose money in a secular bull market because I'm betting against, I'm betting that it's going to go down. It's just, everybody has their own, I guess, demons when they're trading, and that's one of mine. I just don't like to bet against a bull market. But, FireEye very easily could gap up and then come all the way back down, fill that gap. Who knows? Another one is Tenable, TENB. Yesterday came out, had a profit of 4 cents. Market was expecting a loss of 5 cents. Big gap up. Whoops. Try that again. I'm having some problems with my charts. I don't know if it's my internet or what's going on here. Let's try a different screen here. All right. So there's a gap up, and you can see immediately we opened at 34.70, and we're 2 minutes in, and the stock went down to 32.81. $2 in the first 2 minutes to the downside after gapping up. So that's what I'm saying. If you just jump in right at the opening bell and say, oh, this is a good report, I'm going to put a market order in at the open, you want to be real careful. Sometimes you get a much better price. So TENB, though, did come out with a nice report, at least a nice start to earnings, response to earnings. Starbucks, one of my favorites. I go to Starbucks every morning. Starbucks gapped up a little bit today. It's up about 3.4%. It gapped above this prior high. Now, it's got some overhead resistance, gap resistance up closer to about 79. So if we get there, we'll have to kind of watch 79.80 area. But Starbucks at least got off to a good start this morning. We'll see. This is one that's not been a good performer on a relative basis. I'm not touting Starbucks. I like their lattes, but I don't really like their chart right now. What else do we have? Well, let's look at one that's not faring so well. How about Seagate Technology, STX? Again, not sure why I'm having this difficulty here getting my charts to come up. There we go. Look at this. Very good support down here around 46. We opened beneath it today. So we're getting a move to the downside. And Seagate missed. They came up with $1.20 in earnings. Market was expecting $1.28. And I can tell you most of the earnings I saw that I looked at, most were higher. Another interesting report, Boeing. Boeing had a huge, not getting the chart up again. I don't know what's going on here. There we go. Boeing, huge miss. Market was expecting a loss of $2.93. They lost $4.79. And they've got the problems with their MAX plane. Was it 737 MAX? So this is just a company going through a lot to the downside right now. I know, we've had these brief periods of excitement to the upside, but they've been followed by weeks and weeks of downward action. Boeing is just not a good performer right now. I'm not going to jump in hoping I get one of these quick moves. I'm going to wait until I see some real relative strength in the stock, and we're just not seeing that yet. One of our companies in our portfolio, Wingstop, reported. Let me pull this one up. So Wingstop reported they came in with 39 cents versus 30. We got a nice reaction to earnings, up 5%, but we haven't broken out. I think we're going to struggle at 145. We got to 142. I just think right now the stock's run up a lot. I wouldn't be surprised to see sideways consolidation. Obviously, a breakout today above, say, 145, 146 would be bullish, but it is a nice positive reaction to a pretty good report. Another portfolio stock, and this is one's kind of fallen apart of late, ZYX. XI. This is in our model portfolio, which has done very well, but this has been clearly the worst performer. Really, I think probably the only bad performer here in July. But you can see the big move down. They announced a secondary offering. I think the stock will rebound once it consolidates, maybe this 18-20 area for a little bit. But it did gap up with earnings, even though the earnings were flat, 9 cents versus expectations of 9 cents. All right, I'll just give you one upgrade here. KHC, this is Kraft Heinz, upgraded. Stock's been looking much better. Look at that accumulation distribution breaking out with price action. This is a more of a conservative play. So if you're worried about jumping into a technology stock because they've run so much, Kraft Heinz might not be a bad alternative. It's not going to make the kind of money that Shopify is going to make, but this is more of a steady performer where you don't have such sudden moves back and forth. Downgrade. How about ALGN? Downgraded today. This is Align Technology. Get this chart to come up. Hopefully, there we go. Yeah, there's the breakout. It was downgraded, but I actually like this stock off the 20-day. Price support's around 290, 20 days at 295. Stock was just up at close to 330 2 weeks ago. Now it's back down 302, close to key support. I actually, again, if it pulls back, I like it on the 20-day. All right, let's wrap this thing up. 3 you must see. I know we're going a little late today. First one is going to be Ryanair. I'm not a big airlines fan, but look at this stock relative to the airline group. It's at a 52-week high. So if I was going to play an airline, it would be this one, or it would be one of these. Again, I'm not a big fan of the airline, so I probably wouldn't touch it. But yesterday, it did make this breakout above the this gap resistance area. It looks like it's probably heading for 82 with that rising 20-day as an area of support that I would watch. But look at all of the hollow candles. Even when the stock opens down, it closes at a high, and that's what's driving this accumulation distribution up. There are a lot of buyers when this thing opens every day. So even when it gaps down, recently we've been seeing buying. So this is an interesting play. Now, this was before the market opened, so I'm going to give you an update. I have no idea what the stock's doing today so far. There we go. Well, it opened down and it's rallying off the open again, which is what we've been seeing throughout this move to the upside. So far, not doing too bad. Next up, SBAC. This is SBA Communications. We got a breakout on it yesterday. Again, I'm not sure if maybe things are just slow at stock charts this morning, or maybe it's my internet. Could be either. There's your area of, what would I be looking for a breakout? 320. So I actually think this is a nice little cup, little consolidation. But that breakout here just recently getting above these failures at 310 suggests we're going to go up test that 320 area. And that's where I'd be looking for a bigger breakout if we can get above that. And then the last one I have is OTIS. This is Otis. And actually, I was looking at this because it had a false breakout yesterday. I was expecting this to go down today. So maybe it's just a good illustration that, hey, technical analysis doesn't work 100% of the time. We haven't broken out above yesterday's high. So I still wouldn't be surprised if it pulled back a little bit. This is not a bad looking chart though. Accumulation distribution looks pretty good. Trying to get this breakout above the June high. You can see coming out of the mid-March low. Talk about a bad time to go public, right in the middle of March. But anyway, coming out of the stock's done very well, and on a relative basis, trying to move to about a 4-month high relative to its industrial machinery peers, and it already has broken out above the S&P 500. So not bad action. Break above 62 certainly would be more bullish. All right, that is it. Had a bunch of questions. I don't normally take questions. Not really sure the question here on the Amazon. Other question is whether or not Amazon should be in the XLP or XLK. That's a good point. Actually, I think some of these companies eventually, I think it's going to be like the Bells. I think they're going to have to break them up. they're getting so big. I think that they're really snuffing out competition. And I'm talking about Amazon. I'm talking about Microsoft. I'm talking about Apple. These are companies that do so many things now. And good companies that have good products are really struggling to compete against them. So I don't know. I think at some point we'll get a breakout. Maybe those companies then can go into the areas that they are designed to go into. Next one, you are looking low scooter. I'm not sure what that means. That may have been when I was running the scans against the chart lists. But in the scooters, I mean, when I was sorting them by scooter, I was actually looking at high scooters as opposed to low scooters. Pre-market on AMD just did a quick down to 60. It probably was an old trade that ran through or something. I never saw AMD trading down at 68 this morning. Okay, so it seems like stock charts is slow. Yeah, I know sometimes they just have some maintenance stuff going on from time to time. It should pick back up again. But yeah, at least I know it's not my internet then. All right, that's it for today. Went a long time today. This is probably our longest Trading Places Live. Wanted to just give you a quick update on the market. We got the market up a little bit. NASDAQ doing a little better than other areas. VIX back down again. I think this is going to be a theme throughout the second half. I think the market moves higher, the VIX comes down. If we get the transports going, that will be the real key, in my opinion. That, a lot of people look at this and say, well, market can't go any higher. Look at how much it's come up off of March. Well, I look at it and say, well, look at where it was in February. We were on a roll. If we don't get this pandemic and all of the economic impacts from that, I said at the beginning of the year, the S&P was going to hit 4,000. Probably looking a little less likely now because of the pandemic. But I mean, yeah, you can pick certain spots out and say, well, the S&P's gone up this much since March. It can't go up any higher. Well, when we get this pandemic behind us, and we will get it behind us, we're still looking at extremely low interest rates. And we had a very strong economy coming into this. So I think we're going to go right back to it. I really do. I think later this year, next year, I don't know when it's going to be. I see the S&P at 4,000 and above. I think we're going to start into a massive move to the upside. And I think it's going to coincide with transports beginning to pick up. And we're going to see transportation lead. But anyway, that's down the road. We'll play what we have for now. Everybody have a great day. Be back tomorrow over at Stock Charts for the next episode of Trading Places Live. Hope you can join me. Until then, happy trading.